It's not live yet.
There we go.
It is February 12th. We are back and we are starting on a new bill, H 649, an act relating to captive insurance companies, and Bill Royale from Legislative Council is going to start us off by walking us through the bill.
Yes.
Great.
I'm happy to do that. I'm just gonna share my screen here. Great. Just a little background. This is the annual captive insurance bill proposal submitted by the Department of Financial Regulation. You will separately have another bill from DFR that deals with the banking, insurance, and securities. So this bill is only captive insurance. There are only 3 sections, and I'm going to do kind of a high-level overview, and then Deputy Commissioner Captive Insurance Christine Brown is here, and she can explain kind of the policy behind why they're making these proposals. So, as you know, captive insurance is a form of self-insurance. There are many different types of captive entities, basically defined by how they're structured or the types of risks that they cover. The 2 types that are addressed here are risk retention groups and sponsored captive insurance companies. So we'll start with risk retention groups because those are the first 2 sections of the bill. These are entities that are authorized under federal law, the Liability Risk Retention Act, I think. But that law basically allows businesses that are in that do similar business. They're in an industry and they have a lot of similarities in terms of the kind of business they do and the types of risk they are exposed to. And so the federal law allows them to form a group. It's member owned. The members are the businesses, and then they collectively manage their own liability risks, commercial liability. So the first section pertains to the legal investments, what they're allowed to invest their money in and not. So the proposal is to add a new subsection specifying that no risk retention group shall make a loan to or investment in its members or affiliates of its members. And this prohibition shall not apply to any loan or investment in effect prior to January 1st, 2026. So again, the members are the owners who are the businesses.
Can I pop you for a second?
Sure.
Oh, you're right at the very beginning. Okay, I thought I was lost.
Already?
I must have scrolled to the top and I'm like, okay, wait, this is exactly what she just read. Sorry.
Yeah, no problem.
Just for my own curiosity, can those businesses be unrelated? Like they don't have to be under the same ownership structure? Like
Yeah.
it can be 20 different construction companies come
Exactly.
together.
Yeah.
Okay.
Yeah.
Gotcha.
And so section 2 also pertains to risk retention groups, and specifically their annual reporting requirements, their financial statements that they must submit to DFR. And so if you scroll on page 2, just so that you're aware, you'll see that the stricken language this applies to all captive entities. There's a specific provision here that pertains to risk retention groups, and you'll see a cross-reference to another section of law. Those are the annual reporting requirements for insurance companies generally. So the proposal is to strike that, and you'll see later on, new provisions specific to risk retention groups. So removing them from kind of the general reporting requirements, and we'll just go through what the new requirements. And then you'll see at the very bottom of that page, beginning on line 20, this section basically cross-references a law that requires that these reports generally be kept confidential, but makes an exception for risk retention groups because under federal law, they're not allowed to be kept confidential. That is maintained just in a different section of law. So it's stricken here. So the new language subsection E basically just says, before March 1st, every year, in a form and manner prescribed by the commissioner, each risk retention group shall file with NAIC, which kind of oversees groups nationally, a copy of its annual statement, convention blank, that the template that insurance companies use to file their financial statements, the signed jurat page, I don't know if I'm pronouncing that right. The actuarial certification is it's a form of notary, it's like a notarized document.
Okay.
Signed by officers, basically attesting to the accuracy and truth of the.
Got it. Okay.
I think that's okay. And any other additional filings prescribed by the commissioner for the preceding year. And then also filing any subsequent amendments or addendums. And then subsection F, so those are the annual reporting requirements. Subsection F basically requires quarterly reports also be filed. And it specifies the dates by which those reports need to be filed. Deputy Commissioner Brown will speak more about all of this, kind of what's happening now and why these proposals are here. And as I mentioned, subsection G specifies, oh no, this is just rulemaking for the commissioner in the event additional requirements are necessary. And then subsection J, again, confidentiality applies to all of these reports except for the risk retention group reports. So section 3 pertains to sponsored captive insurance companies. These are basically entities that provide captive insurance benefits to lots of different businesses. They kind of handle all of the administration, compliance with state laws, and so they can be separate businesses, but they all have their own cell. They're managed separately. Their assets and liabilities are kept separate. But they take advantage of the structure and a sponsor to basically take care of all the administrative requirements. So the proposal here is to specify that 30 days after a protected sale, those are the businesses, that's what it's called, they're separate accounts, shall file with the commissioner a statement under oath or affirmation certifying that the protected sale possessed the requisite funding prior to commencing business, including any required collateral in accordance with the protected sale's approved plan of operation. Commissioner approves those business plans. And then just a requirement that that statement is signed by the executive officers of the sale. With the exception of unincorporated protected sales, then the sponsored captive entity signs on their behalf because they're not officially a legal entity. So they basically have an account. And that's it. So this takes effect in July. Let's see your questions from me. Deputy Commissioner Brown will explain more about why.
Any questions?
Do you want me to stop sharing so that's not on your screen, or is it? I don't know.
I think we have it on our laptop.
Okay, perfect.
I think we have Christine Brown next to speak to the bill. That's Christine.
Thank you.
I must say, when I heard captive insurance, I was expecting like a tone that has like big.
Oh, no, that's the other D for bill. You just wait.
It's coming.
The one is coming.
Hi, everybody. Thank you for having me. For the record, I'm Christine Brown, and I am the Deputy Commissioner for the Captive Insurance Division within the Department of Financial Regulations. So thank you for having me to explain a little bit of the why behind these changes. Maria did an excellent job explaining the changes, but I do have some background I can share. I don't know if you want me to answer specific questions or just go through each section and then give a little background. That would be the most helpful. Okay. Yeah. Excellent. Okay, thank you. So the first change again is around risk retention groups not being allowed to make loans or investments in their members. So the reason why we did this, and this is not a change in our regulatory practice. We have not allowed these loans in risk retention groups for as long as I can remember. We may have one from a very long time ago that has an investment in one of their members, and that's why we included that language at the end to say it shall not apply to any loan or investment in effect prior to the effect January 1st. I think we have one out there, but for as long as I can remember, we haven't allowed this. And the reason why is because we really want to make sure that the premium dollars and the capital that is in the risk retention group is preserved to pay the claims for the members' organizations. And like you would ask the question if they're related or under the same umbrella, and they aren't. So these entities are pooling risks, paying in premium, and then those premium dollars really need to be held and set aside in a reserve to make sure that they can pay claims. And we don't want those funds to be lent out to members. In a different type of captive, a single parent structure where it's the captive owner is just one entity that owns the captive. We do sometimes allow loans back to the parent if there's excess funds in the captive. So but in this case, it doesn't make any sense. And like I said, in practice, we don't do it. So this is just codifying that because we started getting more frequent questions and requests to do it. And we kept having to say no. And it's easier just to put it in statute and make sure that everybody sees it. So.
Is this if I may, I would imagine that if there's one member of the risk retention group or a couple members that are sort of financially shaky, that increases everybody's risk in the group in some way, potentially. And so that's maybe why some of them are asking for money, but it doesn't seem prudent,
Yeah.
given that you're trying to protect everybody.
That's right. Yeah. There's always credit risk associated with the organizations. And so we keep an eye on, making sure they're paying their premium timely. And we don't want to then lend that money back. It doesn't always mean that somebody who's requesting money is on a financially shaky ground. Sometimes they are looking to make investments or do other things, but it's just in practice, it doesn't. And then, you also get into potential conflicts or equity type issues if we're allowing it for one entity and not another member. So it's just best practice not to allow loans. So anybody have any other questions about that? Okay. Great, thank you. So the next section, as explained, changed, or I guess it didn't change. Again, this isn't changing any of the requirements that we've had in practice, what we've done. So we've always required risk retention groups to file annual and quarterly financial statements with us. What happened most recently was we underwent an accreditation process with the National Association of Insurance Commissioners, and I'm happy to report that we got excellent marks. But one of their minor comments was that we're requiring this documentation, but we don't have the requirement for quarterly financials in our statute. So we only referenced annual statements, and this was true on our traditional insurance side as well. So you'll see these similar amendments in that bill when that comes across your desk. So really what we're doing here is just making sure that we're not only talking about the annual statement in statute, but we're also referencing quarterly statements. And instead of referencing the traditional law, which we did, that's the language that you see struck, referencing subsection 3561A. We decided to just put it all in our captive section so that we're not referencing back to traditional law, and we have everything right in our statutes for captives. So again, this isn't changing anything. These rules were in place before with respect to the annual statement being due on March 1st. and being in the form of the, what we call the annual statement that is a form prescribed by the National Association of Insurance Commissioners. That's all the same. And we have always required quarterly filings as well, but just putting it in statute to make it more clear. So, that was an easy fix for us because it is something that we're already doing. And then, as Maria mentioned, the confidentiality section that was struck is just added down to the bottom here to kind of align with where we're talking about risk retention groups specifically. And those reports are filed with the NEIC, so they're public documents, so they're not held confidential like our other types of captives. And then finally, the last section is relating to that protected cell structure. And we find that we've seen a lot of growth in this type of captive. There's some efficiencies with getting into one of these cells. So the structure is already formed, the administration's being taken care of by a sponsor entity, but you can own what they call a cell. I think we've probably talked about this before, but it's similar to a condo or an apartment building where somebody owns it and then different entities rent out what we call cells as their own risk-bearing entity. And because we've seen a lot of growth and because they're very similar to just a small mini captive insurance company, we wanted to align what we require of captive insurance companies generally. In section 6004, we require them to attest to the fact that they've put in the capital and the funding that we've approved upon licensure. And we're just mirroring that same requirement here for cell captives. So it's strengthening our regulation to make sure that when one of these cells forms, they put the money in before they start writing business. That's really what we're doing here, is protecting the cell owners and potential claimants. We haven't had any issues. We haven't found that people aren't funding, but we think it was prudent to kind of match up what we do with other types of captives here for cells.
Just a question,
Yeah.
and that is, aside from requiring audits and so on, independent audits, what forms of accountability exist to give you comfort that what's claimed is in fact true?
Sure. Well, we have the audit requirement. We also have an actuarial requirement. So every year that all captives have to get an actuarial report and opinion that says that the reserves that they're booking are adequate, and then that amount is audited as well. And then every 5 years, we go in ourselves and do an examination. So it's a statutory examination. We look at financial risks and also compliance risks to ensure that the captives are following their business plan and that the financial statements are reported accurately. And then we use these filings that are referenced here. Every captive has to file an annual report, which is separate from the audit. It's kind of our first look at the results. It comes in before the audits do. And those are used to conduct financial analysis. And we do that every year to make sure that that's really a higher level look. So we're looking at trends, financial ratios, just to make sure that everybody's looking okay. And that if there are any trends that are negative, we immediately will contact that captive insurer and work on a plan to get them back into it.
And you're using your own staff examiners to do those individual reviews on site at the insurance place of business, or not?
Well, so we use our own staff. We have a staff of 32, but we don't usually go on site to these businesses. They're located all
over the country
and the world
Yeah.
now too. We have 10% that are global. So we do a lot of the work remotely after COVID. We've been, a lot of the systems are now electronic, so we're able to do a lot of our testing remotely. But there's also captive managers here in Vermont, and primarily around the Burlington area. And we visit their offices. They're the ones that do the accounting and the day-to-day operations for the captive insurers. So we'll visit them. And we conduct interviews remotely through Teams meetings with board members for captive insurance companies when we do our on-site or our statutory exams as well.
Have you found any violations of substance in any of the reviews that you've done?
Throughout the years, we do have findings. If they're substantial, they're included in the examination report. And then we work with companies. It's called a company action plan. And basically we have to put them on a plan, to get them to kind of comply with whatever violation it was. A lot of times they're more around solvency and less around compliance, statutory compliance. And we just work with companies to make sure that they're maybe increasing premium, or it's usually with group captives, like risk retention groups, where we see this more often. Pure captives, because it's their own risk, it's their own company, they tend to fund and put money in whenever they need to. But it's these group captives that have smaller members where we have to really pay very close attention to make sure they're solvent.
Have you had any situations in which there have been violations of such magnitude that you've had to take either regulatory action, or you've had to terminate the relationship, or anything else?
We do sometimes have to take regulatory action, and it's usually from a solvency perspective, and we hire a special deputy rehabilitator. We have a contract with somebody out of Boston who's in a law firm, and they do an excellent job in helping us rehabilitate companies or liquidate in some cases if we have to. It isn't frequent, but it does happen, and it's good that we have that in statute. We have the ability to take over a company and then, make sure that if we're seizing assets, we're making sure that payments are being applied equitably to members of these groups.
Have there been any situations in which you've had to make public the details of any action that you've taken like this?
Yes, we have them posted on our website. So sometimes it takes a long time because the coverage is, long tailed, and we're working through settling claims. So the details are posted on our website. We do have, I think, a couple up there right now that are posted publicly. So yeah. Anytime there's an action like that, we post it to make it public, because, if there's other entities or people who are, have an interest, we want to make sure that they know what's going on.
The risk retention group aspect of captive insurance is relatively new, right? Or didn't start though at the beginning? It was just the sort of single captives. Now the risk retention came later.
No, they've been around since the
Okay.
80s too.
Okay.
And they really, first there was a liability insurance or a product liability need in the market, and people companies weren't able to get that. So that's the initial reason why they formed. But then very quickly medical malpractice was an issue for a lot of hospital groups. So the majority of risk retention groups early on were formed to provide medical professional liability for hospitals. In Pennsylvania, that market was really shrinking. And so all of those risk retention groups are still around today. So they've been very successful, but the groups have been around for a long time.
Okay.
The cells are more new.
Okay,
That might be what you're
that's what I'm
talking about.
thinking about.
Yeah.
It's funny as soon as you said cells, I remember this period. very specific testimony, like the first year I was in this committee, about the cells and how they worked. And I have this visualization in my head about that. Anyway.
Yeah, I think the condo,
Yeah,
you know,
it was
is
the
a
condo,
good, it like brings it kind of, and I think it's easier to understand when you think of it that way.
Yeah.
Like an owner and then renting out the license basically is what the cells do. Yeah.
All right, ready for the next witness? Ian Davis, President of the Vermont Captive Insurance Association.
Good afternoon, everyone. Ian Davis, President of the Vermont Captive Insurance Association. Just want to start by, again, thanking you for your time. I obviously heard from Maria and Christine now on the substance of the bill, so I thought I would devote just a few minutes to talk about how it is that the bill is developed and the process that we follow as an association each year, working in tandem with the department to put forward really a consensus bill each and every year. And it's critically important to Vermont. I mean, many of you who've been on this committee now for several years, you know this and have heard this, but it really, from even a reputational standpoint, is really important that Vermont is seen as always looking to innovate and making sure that we are not resting on our laurels from a statutory standpoint and looking to evolve with the needs of the marketplace. So you know, I talked about the process. It begins early and often in the fall timeframe, where we solicit input from our, 430 plus member organizations. We invite them to, provide input and suggestions as to what they would like to see, whether it's, again, new or innovative risks or issues that they're running up against and adhering to the statutes that exist. We then kind of vet those through our advocacy committee, which is the kind of our legislative and regulatory committee, again, comprised of a diverse kind of cross section of our membership, but many of them are captive insurance attorneys that live and work here in the greater Burlington area. And ultimately, we begin having introductory conversations with the department to kind of introduce what proposals the membership would like to see presented. It usually involves many back and forth conversations. I think we both share a goal of bringing forward a consensus bill. Again, we really want to be seen as good partners in all of this, and we recognize the importance of kind of shepherding this industry in a responsible manner. And clearly that is reflected in this year's bill. I mean, it's not particularly substantive, but these are meaningful updates. I mentioned, wanting to give you a perspective from the broader kind of captive industry and how they view this annual exercise that we do. We've often talked about it as an annual tradition. I would say in many ways today it is an expectation of the industry that Vermont will have a bill that will pass, that it will be seen as a thoughtful kind of modernization of their captive statute. So it is really, from a reputational standpoint, critically important that we continue to do this. I would note, however, that, and this came up in House Commerce where we introduced the bill initially, is talking about how important this exercise is. I think we had a legislator challenge us and say you should come back next year with a more meatier bill, because I think, and truly, it's important that we continue to look to. I don't want to say be, certainly not on the bleeding edge, but be leading edge when it comes to innovating within this industry, and even things that are within our own control, like cleaning up the statute, and whether that's eventually a comprehensive rewrite or things that we can be doing to make it easier for companies to do business here in Vermont. And so I'm new to the association as of 6 months, but I've worked in this industry for going on 10 years now. Under my leadership, that's certainly something that I intend to look to do, is to actively and more proactively be engaging our membership in meaningful ways so that we can really ensure that, we're not just resting on, as I said, our laurels and what's made us successful for the last 40 years, but what's going to propel us into the next 40 years, and how can we shepherd this industry forward in such a way that, is consistent with Vermont values, is consistent with what has made us successful for, the last 30 or 40 years. So more to come. But again, we really couldn't do any of this without all of you. And I just want to, every time I'm here in the seat, want to thank you all for your service to Vermont, for your service to our industry. It really does, have a material benefit on, Vermont's economy, on people who live and work here every day. And we just, really appreciate your being such willing partners with us and shepherding this industry. So thank you. Happy to.
They don't have a meaty bill unless you need it.
Well, we would do it, I think in a thoughtful way, but yes, like I said, more to come.
There you go.
Thank you.
Thanks.
Thank you very much.
That's all we have on the agenda.
Okay.
Stay here till the chair comes back before we adjourn, or? Nah.
Nah.
We're running all right.